Hello, my name is Ken Edelstone, and this is my financial analysis project. I'm going to go ahead and start with the gaming industry. Our first company is MGM. Here's a few key ratios. The current ratio, which is 1.22 for the last fiscal year, it shows that their current assets cover their current liabilities, which is good. Their quick ratio, which is over 1 as well, shows that they don't keep a lot of inventory on hand, which is also very good. Their cash ratio is relatively high for the industry, which is semi-alarming because they can maybe reinvest some of that cash into something else to make them more money, but it's still relatively good. And also the cash coverage ratio is 2.22 as well, which means they can cover their interest expense, which is also good. They did not have a PE ratio available. That may be because they have negative equity or their net income is negative, so there could be multiple factors as to why their PE ratio is negative. This is MGM's return on equity breakdown. As you can see, tax burden's been, pretty constant for the past 5 years. Over the past 5 years, interest burden's kind of been all over the place as well. That is definitely driving their negative ROE. Equity multiplier again stays the same. Total asset turnover also stays constant, as well as profit margin. Profit margin, for the most part, has been in the negative for the past 4 years, with the only positive year coming in 2011. The next company is Boyd Gaming Company. For the last fiscal year, their current ratio is 0.74, which is alarming because their assets are not covering their liabilities. Their quick ratio relative to their current ratio is okay because that means they don't keep a lot of inventory on hand, but as we said before, their assets aren't covering their liabilities. And their cash ratio is relatively low. It's about half of what MGM's was. Their cash coverage ratio is above 1, which is good. That means they're covering their interest expense, and they also did not have a price to earnings ratio because of maybe possibly a multitude of factors. And for the Boyd Gaming ROE breakdown, as you can see, tax burden has been the same, which has been relatively constant, which you really had no control over. Interest burden has been all over the place. As you can see, it is negative 584 for the year of 2012. That's also driving their negative ROE. Profit margin has consistently been negative with a very low asset turnover. Okay, and the next company is Penn Gaming. Their current ratio is a 1.41, which is good. Their quick ratio is almost at a 1, which is good as well. Like I said, they don't keep much inventory on hand, and their cash ratio is relatively high as well. It's the same as MGM, which is pretty good. But they could also probably reinvest some of that cash into some other ventures to try to accumulate and try to make some more revenue, create some more revenue streams. Their cash coverage ratio is excellent. They are covering their interest expense almost 7 times over, so that is a good trend. And they also did not have a price to earnings ratio. Here's Penn Gaming's ROE breakdown. Tax burden, which we're not really too much concerned about because you can't control your taxes. Interest burden has been exceptionally low this year, relatively speaking, with a constant equity multiplier, constant asset turnover, which are very low, below 1, respectively, and the profit margin has been consistently negative as well, with a negative profit margin this year as well. The Isle of Capri key ratios. Again, another current ratio over 1, which is good. Their quick ratio is good relative to their current, meaning they don't have as much inventory on hand. Their cash ratio is up there with the two better companies in this industry, and their cash coverage is good as well, having covering their interest expense twice over. This company Isle of Capri did have a price to earnings ratio, which is relatively high. They must have a good outlook on the future, a good future earnings potential as far as that goes. This is the Isle of Capri's ROE breakdown as well. For the most part, positive, very, very small. A lot of these equity multiplier, asset turnover, there's ratios all below 1. between 0 and 1, as well as profit margin between 0 and 1, you can't even see it. Tax burden for 2012 was outrageous, but again, we can't control that, so it's not as alarming as you may think. Interest burden's been fairly consistent throughout, with a positive interest burden in 2009, capping it off. And last but not least, Pinnacle Entertainment. Their current ratio is a 1.61, which is good. Their quick ratio is significantly lower than their current, which is a little alarming because they must keep some type of significant inventory on hand. Their cash ratio is mediocre, and they did not have a cash coverage ratio for this company either. Their PE ratio is above 1, so they have some good outlook. They have a good outlook on what they could potentially earn in the future, which was also surprising to me. And the Pinnacle ROE breakdown, as you can see, it's been a little inconsistent. ROE's been consistently negative with a record. With a high in the past 5 years being this year, last fiscal year in 2013. The tax burden, as you can see, has been inconsistent as well, but like I said, we can't control that. Interest burden has been consistently negative as well. Equity multiplier, again, small amount of leverage, small asset turnover between 0 and 1, and coupled with a negative profit margin, which also is not ideal. Some economic value added figures for the gaming industry this past year. So for the fiscal year 2013, MGM has a positive economic value added, which is good because it means that you're making more money than you should be making, which is good. Boyd was in the negatives, along with Pinnacle. Pinnacle was also very negative in the economic value added category as well. Penn Gaming coming out with the highest EVA in this industry with 164.25, followed by Isle of Capri with 43.19. And for me, the industry winner is the MGM Resorts International company. They were more consistent across the board to me than any other company. And as an investor, I value consistency, and they showed some growth potential with a nice price earnings ratio. So I would look to invest in that industry, in this company, in this industry. I would actually not want to invest in any of them. So, but if I had to pick, this would be MGM. All right. The next industry I picked was food manufacturing, and the first company that we were going to discuss is Tyson Foods. You might know Tyson. They have prepackaged dinners and things like that. It's a very well-known food manufacturing company, and their current ratio is 1.86, which is high, which is very good. Their assets are covering their liabilities. Their quick ratio, like the example before, is relatively low compared to their current, which means they must keep some inventory on hand, which isn't that as alarming because they're a manufacturing company. Their cash ratio is significantly lower than their quick ratio, so they must not keep a lot of their assets in cash, which is okay. Their cash coverage ratio is outstanding. They're covering their interest expense 12 times over, and they have a nice price to earnings ratio of a positive 11.62, which means they are expecting future earnings. Now Tyson's ROE breakdown is a little better. As you can see, ROE's been consistently positive for the past 4 years. Tax burden, besides the year of 2009, has stayed consistent as well. It's been in the high 50s, low 60s. Interest burden has also stayed fairly consistent within the past 4 years, and as you can tell, the equity multiplier, asset turnover, and profit margin have also stayed very, very consistent within the past 4 years, which is a good thing. All right, the next company that I picked is General Mills. They produce a lot of cereals. They manufacture a lot of cereals and things like that. Their current ratio for the fiscal year of 2013 is less than 1, which is kind of alarming because like I said, their liabilities are not covering their assets. The quick ratio is half the current ratio as well, so they keep a lot of inventory on hand. and their cash ratio is significantly less than their competition at 0.14, which again is not as alarming as it may seem. Cash coverage ratio is very good. They're covering their interest expense 10 times over, and their price to earnings ratio is also positive, 19.08, which means they are expecting future earnings, higher future earnings. This is General Mills' ROE breakdown as well. As you can see, their tax burden has been staying ultra consistent, interest burden ultra consistent, equity multiplier ultra consistent, along with your asset turnover and your profit margin have been extremely consistent, which would accompany a positive ROE. For the next company is Heinz Company. They produce Heinz ketchup and other things like that. They're a food manufacturer. Their current ratio for the fiscal year of 2013 has been 1.07, which is good. Their quick ratio, 0.699. They keep a little inventory on hand, but that's okay. Their cash ratio is 0.51. They can maybe reinvest a little bit more of that cash to make it work for their company. And their cash coverage ratio is good as well. They're covering their interest expense at 7 times over, which has been the staple of this whole industry. Is they all have high cash coverage ratios. Their price to earnings ratio is also very good, 20.01 positive. That means they're expecting future earnings as well, high future earnings. This is Heinz's ROE breakdown. As you can see, it's very good. ROE has fluctuated some, but it's been consistently positive. Their tax burden also has been consistently positive, consistent in the area that it's been. Interest burden as well, which is good. My equity multiplier has been consistent, along with asset turnover and profit margin. This leads to a positive ROE. It's in the 30.32 range, 32.43, I believe, is what it is for this past year, what it was this past year, which is very good. The next company is Hormel Foods. Their fiscal year for 2013, their current ratio is 2.61, which is very good. Their assets are they're 2.5 times, over 2.5 times covering their liabilities. Their quick ratio is also over 1, which is also very good. They do keep a significant amount of inventory on hand, but they still have a quick ratio above 1. And their cash ratio relative to their quick is very good as well. They reinvest some of that cash. They reinvest a significant amount of that cash as well. Their cash coverage ratio is incredible, being 73 times. They're covering their interest expense 73 times over, with a price to earnings ratio of 22.37, which is also very, very good for the future outlook of the company. Hormel's ROE breakdown is also very, very good. ROE has stayed consistently positive, mostly because the numbers have been consistent throughout. Profit margin has been consistently positive as well, with a low asset turnover. It's right at 1, with low leverage, so that's very good as well. They don't have to incur debt to make money. Hershey Foods Company is the last company in this industry. For the fiscal year 2013, their current ratio is 1.77, which is good. Their quick ratio is also over 1, which is good as well. Their cash ratio is relatively high. Maybe they can reinvest some of that cash into other things to maybe boost that ROE even more. The cash coverage ratio is awesome, 16 times over, almost 17 times over, with a very, very good outlook on the future with future earnings. Hershey's ROE breakdown, their ROE has consistently been one of the tops in this industry. With the fiscal year ending, it was 63.84 for 2013. Their tax burden has stayed consistent, which they can't control, but it's very good that it stayed consistent, along with their interest burden. Asset turnover is a little better than the competition in this industry, with that profit margin being significantly higher and as well as they have a little bit more leverage than the other industries, but they may be taking more advantage of leverage than other industries other companies in this industry should be taking advantage of, because they all have relatively low leverage compared to Hershey. A little bit of economic value added for the food manufacturing industry. Tyson comes in with 376.85 positive economic value added, which is good. They're making a lot more money than they should be. General Mills is outstanding this year with 1255.42. Heinz and Hershey are in the negatives with negative 1,310.62 and negative 6,426.54 respectively. Now, my industry winner is maybe a little bit differently than what you may have thought. I picked the Hershey Company because even though they had that really low economic value added, I still like them because they have a high growth potential, they have a high price to earnings ratio. Their numbers were extremely consistent with their current ratio, their quick, and their cash. I like where their cash ratio was at. So I like how their profit margin was a lot higher than the rest of the industry as well, and they were taking adequate advantage of leverage. So if I were to invest, I wouldn't be bogged down by the economic value added number. I would focus more on the profit margin that stayed very consistent, and the total asset turnover that stayed consistent, and the consistent positive ROE, the highly positive ROE. Now, the next industry is the wireline telecom services industry, and my first company is CenturyLink. And here's a few of their key ratios. For the fiscal year 2013, their current 0.89. Again, it's not over 1, so their assets are not covering their liabilities. For the quick ratio, they keep a nice little amount of inventory on hand. As you can see, cash ratio is extremely low. Either that's, could be reinvested or things like that into the company to try to make money, because their cash coverage ratio is good as well. They're covering their interest expense, and they have high future earnings potential with their, the market thinks that, they're going to have some high earnings, high yield earnings in the next year or so. Here's CenturyLink's ROE breakdown. It's been up until this past year, it's been positive. Their ROE's been positive. Their tax burden went way below zero. Their tax burden is significantly negative this past year, which is, as you can see, is probably driving this negative ROE. Interest burden, they've lowered their interest burden. Their their leverage has stayed the same, which is good. Their asset turnover is greater than 0 but lower than 1, and their profit margins have been positive, but this past year with that tax burden, it's been driving a negative profit margin and ultimately a negative ROE for this past year. The next company is Frontier Communications. For the fiscal year 2013, their current ratio is 1.24, which is excellent for the industry. Their quick ratio is 1.04, which is also excellent. They're not keeping much inventory on hand. Their cash ratio, respective to their quick or their current, is very good as well. They could probably reinvest some of that cash, but they're staying liquid. So their cash coverage ratio is consistent, 3.27, covering their interest expense, with a high outlook on future earnings at 22.3 for their price to earnings ratio. Their ROE breakdown for Frontier Communications, they have been consistently positive as well. Within the past 4 years have been pretty consistent. Tax burden has been fairly consistent as well. They've lowered their interest burden. Then within the past 4 years, they've stayed in the same area with equity multiplier as well. It's been super consistent. As you can see, asset turnover is also greater than 0 but less than 1. Their profit margin as well has been consistently positive, which is a good sign for any investor. The next company is the Telecom Communications. For the fiscal year 2013, their current ratio is really high, 2.14, with their quick ratio at 1.89, which means they really don't keep much in inventory. Their cash ratio is very, very high. I would definitely suggest, maybe reinvesting some of that into other entities or what have you. Their cash coverage is again very good at covering their interest expense. Plus their price to earnings ratio is really, really high. The market must see very high future earnings with telecom. Here's the ROE breakdown. As you can see, been consistently positive in ROE, driven by a semi-consistent lineup of factors, but with this one outline, 2010 tax burden, probably driving that little bit of spike in ROE, but everything else the same. It's been pretty consistent. As far as profit margin, asset turnover, equity multiplier, they've all stayed pretty consistent. Again, equity multiplier greater than 0, less than 1. And the next company is Broadview Networks. They're a holding company, so their current ratio was 1.13. They're covering their liabilities, their assets are covering their liabilities. Their quick ratio, they're not keeping much on hand, and their cash ratio is relatively low compared to the rest of the industry, which is good. They're reinvesting that money. They did not have a cash coverage ratio, and they did not have a price to earnings ratio due to, could be a multitude of things, negative equity or negative net income. Broadview's raw return on equity, they had no return on equity. Their tax burden has been fairly inconsistent within the past 5 years. Their interest burden has been it's been negative, it's consistently negative. Their equity multiplier has been, again, small. Asset turnover small, and profit margin very, very small. The last company in this industry is Level 3 Communications. Their current ratio is right at 1, which is good. They're covering their liabilities. Their quick ratio is very close to their current ratio, which means they're not keeping much in inventory on hand at all. Their cash ratio is relatively mediocre, which is good. They've reinvested some of that money, but they've also kept some in cash, which is okay. Their cash coverage is good. They're covering their interest expense, and they also did not have a price to earnings ratio for this last fiscal year. That was the only fiscal year that they were missing, so something may have happened that they obviously had some negative net income or negative equity this past year. Now ROE has been pretty consistently negative. It's mostly driven by a negative profit margin. They may not be adequately taking advantage of leverage. Very small asset turnover, and their interest burden has been all over the place. They have a really low interest burden at negative 12.75, and it's been inconsistent that was for 2011, and they still have a negative 1 for 2013. It's very small. And for the economic value added for the wireline telecom services, we have, for the last fiscal year, CenturyLink has been the spike, at the top for economic value added with 1,136.27. Very good. They're earning a lot more than they should be earning, which is good. Same thing with Frontier. Frontier has had pretty consistent numbers throughout. They are at 59.02, again, earning more than they should. These next three are all in the negatives, Telecom and Broadview being fairly close to each other in the negative 60s, and Level 3 Communications almost approaching negative 300 for their economic value added. And for the industry winner, I picked Frontier again because their numbers were consistent, their ROE was consistently positive, their profit margin was a little better than the rest of the industry, and also their interest and tax burdens have been consistently staying where they were for the past 5 years. And the overall winner to me is the Hershey Company. I think that the food manufacturing industry is a more stable industry to invest in. If I had to pick between my three winners, I would invest my money in the Hershey Company. They had a high PE coupled with a high positive ROE, which is what we're actually looking for. And that concludes my financial analysis. Thank you.